welcome to the Bank of Canada and this morning's press conference about today's interest rate announcement and monetary policy report. Comme d'habitude, le gouverneur Macklem va prononcer sa déclaration
Governor Macklem will make an opening statement, and after that, we will turn to your questions.
Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions until about 11:15 or so. Alors, Monsieur le Gouverneur, la parole est à vous.
Thank you, Governor.
Good morning, everyone. We are very pleased to be here, or I am very pleased to be here, with Senior Deputy Governor Carolyn Rogers to discuss our decision and our new monetary policy report. Today, we lowered our policy interest rate by 25 basis points. This is our 6th consecutive decrease and brings the policy rate to 3%. We also announced our plan to complete the normalization of our balance sheet, ending quantitative tightening. The bank will restart asset purchases in early March, beginning gradually so that its balance sheet stabilizes this year and then begins to grow modestly in line with economic growth. We have 3 main messages this morning. First, inflation has been close to the 2% target since last summer. Monetary policy has worked to restore price stability. Second, lower interest rates are boosting household spending and economic activity is picking up. But third, the potential for a trade conflict triggered by new U.S. tariffs on Canadian exports is a major uncertainty. This could be very disruptive to the Canadian economy and is clouding the economic outlook. Today,
we lowered the policy interest rate by 25 basis points. This is our 6th consecutive decrease and brings our policy rate to 3%. We also announced our plan to complete the normalization of our balance sheet, ending quantitative tightening. The bank will restart asset purchases in early March, beginning gradually, so that its balance sheet stabilizes this year and then begins to grow modestly in line with economic growth. We have 3 main messages this morning. First, inflation has been close to the 2% target since last summer. Monetary policy has worked to restore price stability. Second, lower interest rates are boosting household spending and economic activity is picking up. And third, the potential for a trade conflict triggered by new U.S. tariffs on Canadian exports is a major uncertainty at this time. This could be very disruptive to the Canadian economy and is clouding the economic outlook.
Since the scope and duration of a possible trade conflict are impossible to predict, the NPR projection we published today provides a baseline forecast in the absence of tariffs. We also provide some discussion of the potential consequences of a major trade conflict. Let me expand on the first 2 messages before turning to the threat of tariffs. First, inflation. A year ago, inflation was 3%. Short-term expectations were still elevated, and inflationary pressures were broader than normal. In recent months, inflation has remained close to 2%. Business and consumer expectations have largely normalized, and there is no longer evidence of broad-based inflationary pressures. Shelter price inflation remains elevated, but is gradually coming down. While we expect some volatility in CPI inflation due to temporary tax measures, our forecast is that inflation will remain close to the 2% target over the next 2 years. Second, growth. There are signs economic activity is gaining momentum as past interest rate cuts work their way through the economy. Lower borrowing costs are boosting activity in the housing market, as well as spending on big-ticket items like automobiles. The pickup in household spending is starting to broaden to other consumer items and is projected to strengthen further. Business investment has been weak, but is forecast to increase gradually. And the outlook for exports is being supported by new export capacity for oil and gas. Employment has strengthened in recent months, But with job creation having lagged labor force growth for more than a year, the labor market remains soft. The unemployment rate was 6.7% in December, and wage pressures, which have proven sticky, are showing some signs of easing. The bank forecasts GDP growth will strengthen from 1.3% in 2024 to 1.8% in 2025 and 2026. Growth in GDP per person is projected to pick up as lower interest rates and rising incomes support spending. The projected increase in overall GDP growth is more modest than it was in October, largely due to lower population growth that reflects new federal immigration policies. There are risks around the outlook, and Governing Council is equally concerned about inflation rising above 2% or falling below it. Absent the threat of tariffs, the risks to the inflation outlook are roughly balanced. Let me now turn to the question of tariffs. U.S. trade policy is a major source of uncertainty. There are many possible scenarios. There's a lot we don't know. We don't know what new tariffs will be imposed, when, or how long they will last. We don't know the scope of retaliatory measures or what fiscal supports will be provided. And even when we know more about what is going to happen, I do need to be clear, it's still going to be difficult to be precise about the economic impacts because we have little historical experience with tariff changes of the magnitude that the U.S. is contemplating. Nevertheless, some things are clear. A long-lasting and broad-based trade conflict would badly hurt economic activity in Canada. At the same time, the higher cost of imported goods will put direct upward pressure on inflation. The magnitude and timing of the impacts on output and inflation will depend importantly on how businesses and households in the United States and Canada adjust to higher import prices.
Unfortunately, tariffs mean economies simply work less efficiently. We produce and earn less than without tariffs. Monetary policy cannot offset this. What we can do is help the economy adjust. With inflation back around the 2% target, we are better positioned to be a source of economic stability. However, with a single instrument, our policy interest rate, we cannot lean against weaker output and higher inflation at the same time. As we consider our monetary policy response, we will need to carefully assess the downward pressure on inflation from weakness in the economy and weigh that against the upward pressure on inflation from higher input prices and supply chain disruptions.
Unfortunately, tariffs mean economies simply work less efficiently. We produce and earn less without tariffs. Monetary policy cannot offset this. What we can do is help the economy adjust. With inflation back around the 2% target, we are better positioned to be a source of economic stability. However, with a single instrument, our policy interest rate, we can't lean against weaker output and higher inflation at the same time. As we consider our monetary policy response, we will need to carefully assess the downward pressure on inflation from weakness in the economy and weigh that against the upward pressure on inflation from higher input prices and supply chain disruptions. So let me tell you what we're doing in preparation. In recent years, we have invested in better information on supply chains, trade links, and the connections between sectors. And this is helping us analyze the effects of supply disruptions, including tariffs. We've begun assessing the possible consequences of different tariff scenarios, and we present an example in the Monetary Policy Report. We are stepping up our outreach activities across the country to hear directly from those affected by trade uncertainty. This includes augmenting our surveys of business and consumers to better understand how trade uncertainty is affecting their decisions and how they would cope in the event of a trade conflict. We will update you on our analysis and assessments as developments unfold. Having restored low inflation and reduced interest rates substantially, monetary policy is better positioned to help the economy adjust to new developments. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time. With that, the Senior Deputy Governor and I would be very pleased to take your questions.
Okay, thank you, Governor. And we will go to questions now, starting with the roughly dozen or so reporters I have here in the room in Ottawa, after which we'll go to those who have joined us remotely. As usual, I'll ask you to please limit yourself to one question so that every media outlet does get a chance to ask. And if I forget to do so, please state your name and affiliation. Please remember to use the microphone here in the room to ask your question.
And before you ask your question, please identify yourself, give your affiliation, and of course you are able to ask your question either in English or French.
From the Wall Street Journal.
Governor, the decision talked about how the Canadian dollar is depreciated materially. Does this indicate that the so-called limits of policy divergence have been reached and BOC officials are worried about its potential impact on inflation? And would a weaker currency limit the Bank of Canada's ability to provide support in a trade conflict?
Okay, you packed a lot in there, Paul, and I know you know this, but I do want to begin by reminding everybody that we don't target the exchange rate. The flexible exchange rate is an integral part of our monetary policy framework that allows us to gear monetary policy in Canada to the specific situation in Canada. So if you're asking us, has the movement in the Canada-U.S. exchange rate constrained our monetary policy decisions to this point? The answer is no. We've cut our policy interest rate 6 consecutive times now, bringing the rate down from 5% to 3%, 200 basis points. That is having some impact on the Canadian dollar, but as we discuss actually at some length in the monetary policy report, that effect is relatively modest. The depreciation we've seen, the recent depreciation we've seen in the Canadian dollar has been more driven, in our view, by trade uncertainty, and particularly President Trump's threats to impose 25% tariffs on Canadian exports. You can see that from a number of things, but in particular, if you look at the timing of the depreciation, it follows very closely on President Trump's threats. This is a more material move in the Canadian dollar. I mean, if you go back to October, Canadian dollar was 73, 74 cents. It's now it's now sort of 69 to 70. So look, that is a material depreciation, and it will start to have some impacts. Depreciation makes our exports more competitive. Of course, the threats of tariffs will make them much less competitive. But it also has some other impacts. It means that everything we import the cost of things we import, it will be higher. And you will start to see that relatively quickly on things like fresh fruit and vegetables, which obviously it's winter in Canada. We import a lot of those from the United States. That'll get passed through pretty quickly. More generally, pass-through tends to be pretty slow. It tends to evolve over time, but that is something that we have built into the outlook that you see today. The other implication of a weaker Canadian dollar is that any intermediate inputs, so for example, machinery and equipment, investments Canadian companies make, buy equipment from the United States, that becomes more expensive. That will hurt our investment. So those things, we've assumed a 70-cent dollar in the projection that we published today, and the depreciation we've seen so far is built into that. Going forward, look, there's no doubt the exchange rate is responding to the threat of tariffs, and I think it's reasonable to expect that as developments unfold, that will be financial markets. We'll take that on board. It'll be reflected, and that is something that we will have to build in to our outlook. And obviously, the bigger the movements in the Canadian dollar, the more we're going to have to take those into account as we set policy going forward.
Okay, we'll go now to Promit Mukherjee from Thomson Reuters.
Thanks, Paul. Good morning, Governor. you have said that in the event of a 25% tariff and possible retaliation from Canada, monetary policy might not be able to offset that. But do you think quantitative easing will be one of the tools that you can resort to?
So I think what you're saying is, your question is, what's going to happen to interest rates if 25% tariffs are imposed?
No, actually, I wanted to understand that is quantitative easing one of the tools?
Oh, quantitative easing. Sorry, I missed that part. Okay. We're a long way from needing quantitative easing. I mean, our policy rate is at 3%. We recently published a review of our use of our extraordinary tools during COVID, and what we concluded was that the bar for using quantitative easing in Canada has always been very high. In fact, we've only used it once when we had a once in a 100-year pandemic. And the bar for using quantitative easing should remain very high going forward. We're a long way from that, and we have plenty of room with our policy rate.
Okay, next I'm going to go to Kevin Carmichael of The Logic. I'm being told that the mics here in the room aren't picking up very well on the webcast, so please do your best to focus into the microphone when you're asking your questions. Kevin.
Good morning. To what extent are the threat of tariffs baked into what you've done today, the policy decision and the forecast? I know you've laid out in excellent detail about how difficult it is to anticipate what might be coming, but did you try to factor in the tariff threat in any sort of way in what you've done today?
Well, I'll answer that in two parts. With respect to the forecast that we published in the Monetary Policy Report, I think we're very clear. It assumes that there are no new tariffs. It does include a modest effect of the uncertainty being created by the threat of tariffs, particularly on investment. But effectively, in the projection, we're assuming that the threat of tariffs, it's a rather nice scenario. The threat of tariffs dissipates, that uncertainty goes away, and we don't have to deal with it. We go on in the second part, of course, at looking at a scenario where there are broad-based and actually permanent new tariffs to give some idea of what the impact would be. But that is not a forecast. Coming to the decision itself, obviously the forecast is an important input in the decision, but obviously the risks around it also factor into the decision. We've got to look at the whole landscape. So, I mean, if you start with the facts on the ground, what's going on in the economy, what you see is that inflation has remained pretty close to 2% since last summer. And if you look at all our indicators of inflation, underlying inflation looks like it's running around 2%. We're not seeing broad-based inflationary pressures. Secondly, the economy is still in excess supply. Labor market's soft, unemployment rate 6.7%. That softness in the economy, that slack in the economy, that is putting downward pressure on inflation. We want to see growth pick up, take up that slack to keep inflation close to 2%. And we are starting to see that. Growth is picking up, and we want to see that pick up sustained to absorb that slack. So, I think those things suggested that, a further cut made some sense. Then you look out the window, and the threat of tariffs is there, and there's no doubt, that weighed on our decision. The more we can get the economy on a solid footing before it faces new tariffs, the better. And from that risk management perspective, I think that reinforced the decision to cut the policy rate by 25 basis points.